India is the world's third largest oil importer. It imports 86% of its crude oil requirements to make the petrol and diesel that is sold by domestic companies like Indian Oil and Hindustan Petroleum. Iraq is the top oil supplier. Saudi Arabia, UAE, Nigeria, and the US are other key sellers. Therefore, any geopolitical tension affecting the supply of crude oil does not bode well for the Indian consumers as well as the government finances. Crude oil prices have been on the boil for some time now, gaining around 60% over the past year because of tight supplies. The OPEC Plus, which includes the cartel's allies led by Russia, has been failing to meet its monthly production target since last August. Brent crude, the global benchmark, touched $90 a barrel for the first time in 7 years as rising political tensions between Ukraine and Russia added to concerns that supply could get even tighter. A potential invasion of the oil and gas transit hub of Ukraine by Russia, which is one of the world's largest oil exporters, could disrupt supplies of the key commodities. Analysts expect oil prices to hit $125 a barrel if the situation escalates into a war. Amish Shah of BofA Securities told Business Standard how oil prices may trend over the medium term.
Over and above the geopolitical concerns, COVID is now looking like getting into the endemic phase, which means economies globally will open up, and therefore the demand for crude is likely to increase as well. You and me now start to travel as well. So on the back of that, in the near term, up until June, we think that crude will go up further and hit $120 a barrel mark. But at the same time, we do think that supply will eventually catch up. And once that happens, for as an average for this calendar year, we think crude will settle down at $85, on an average. So crude is already at around 85 right now, which means that in the latter part of the year, in order to come back to 85 of an average, crude will have to be lower than 85. So it's going to be a little bit volatile, swinging up on the upside and then coming on the downside. I would call it out as a risk factor, which could lead to small correction in the market as we go along from now to June.
The dependence on overseas supplies in a high-priced oil market leaves India vulnerable to higher inflation and a weaker rupee. India's crude oil import bill is expected to touch a record $111 billion this fiscal, which will worsen the current account deficit. If oil prices stay at higher levels, rate hikes from the RBI can be expected quicker, say experts. As oil prices fell dramatically from mid-2014, the government took advantage by steadily increasing excise duties on fuel. As a result, central excise collection on petrol and diesel increased very steeply, from 1.37 trillion rupees in FY15 to 2.42 trillion rupees in FY17 to 3.72 trillion rupees in FY21. This improved its finances and brought down the fiscal deficit gradually. However, due to increased government spending to arrest the pandemic-induced slowdown, the deficit worsened to 9.3% in FY21. This time, economists expect the government to meet its fiscal deficit target of 6.8% of GDP. While the centre cut excise on petrol and diesel last November, if it is once again forced to reduce the levy to curb inflation, it will hit excise collections. A fall in revenue will harm the fiscal deficit numbers and also the government's fiscal consolidation plan of bringing the deficit down to 4.5% by 2025-26. Madan Sabnavis spoke on the challenges that the government will face in budget making if high crude prices are expected to persist.
In case we're looking at something like $120 per barrel for the next financial year, I think what the government would be keen to look at is as to what exactly should happen at the retail end. Because we have seen that the prices of petrol and diesel have not really changed, even though the price of crude oil has touched $90 per barrel, ostensibly because we have the state elections coming up. But I'm quite sure that once the elections are over, probably in the month of March or so, there will be revisions which take place in price. Now, this is where the puzzle is really there for the government, because when you're drawing up a budget, I think the assumption which we make of crude oil price is very critical, because it's based on this particular number that a number of your tax assumptions are made, especially on the indirect taxes. And given the fact that today inflation is already in the region of around 5.5%, I think the government cannot just ignore saying that let the prices go where they are. I don't mind petrol now becoming 120 rupees a litre because nobody really objected when the price was 110. So 120 should also be bearable. Because as the prices go up, freight costs also go up, and that will feed into overall inflation. And probably it may talk to the states and nudge them to do something about that to make sure that the prices don't escalate to that extent that inflation goes out of hand. Now, in terms of expenditure, it will, of course, mean a certain minimum additional outlay which will have to be paid on products which are being subsidized, like kerosene and LPG. But that may not be a major dent as such, or it may not be a major concern, but you'll definitely have to make a higher provision. Maybe another 5 to 8,000 crore rupees more will have to be made provision in terms of the subsidies. And this is a particular year in which the government would be looking also at increasing capital expenditure, rationalizing subsidies. I think that's what we spoke of before the price of crude oil reached the levels where they are today. And therefore, I think this will be another tough call for the government to take.
The government, therefore, is in a precarious situation and must prepare the budget based on a reasonable assumption of crude oil prices, as inflation number will become the base on which fiscal deficit projections are made.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.